Welcome back to Rich Dad Stockcast. I'm your host, Phil Dini, and today we're talking about something every investor has in common, and that's mistakes. Now, the difference between successful investors and unsuccessful investors isn't that one group never makes mistakes. It's just that successful investors learn from them and avoid making the same expensive mistakes over and over again. Some investing mistakes cost you a few dollars and others can set you back years. So today, Rich Dad expert Andy Tanner is joining me to break down the biggest stock market mistakes he sees investors making and more importantly, how to avoid them. And before we get into the meat and potatoes of everything, make sure you head over to stockcastbonus.com. Grab your free investing tools. If you want to invest with more confidence and fewer costly mistakes, that's where you start. Andy, welcome back, sir.
Well, I don't know how much time we have. If we're going to talk about my mistakes, it's going to be a long episode. I'll tell you that because I've made plenty of them. So if we're going to talk the mistakes I've made, we hope you got a lot of room on the hard drive.
There we go. First, what a mistake to avoid: not going to stockcastbonus.com. For the ones that do go to stockcastbonus.com, what do they receive when they go there?
Yeah, that'd be a huge mistake to miss out on that. We've changed that site and we update it once in a while. There's tools that you can download for free, calculators that you can download for free that help you build a wealth plan, trading journals you can download for free that were designed by our Series 4 option principal, Corey Halliday. We've got ebooks that you can download for free. We've got webinars you can watch on certain topics for free. And they have your name on them and they're free. So that's why that's a mistake to miss out on those resources. They're fantastic. So again, drop by stockcastbonus.com, pick the things that you would like or all of them and get your free stuff. So there you go.
Nice. Very good. All right. So Andy, you and I, we've known each other for over 2 decades, which just boggles my mind to think about.
Yeah, that's kind of wild to think 20 years, but
it's too crazy. Especially, I feel old as I say that and whatnot.
Well, I look old. You don't look old, so
I'm doing what I can to push the old man out. But going back to thinking about all of our years together, it started off early with trainings and seminars, and you've had over 2 decades of experience of teaching people and new investors. Now, a lot of mistakes come across your table. You see a lot of good and a lot of bad. Out of your 20 plus years of teaching, what's the biggest mistake you see people make before they even buy a stock?
Well, they're the same mistakes that I've made when I was first starting out, really. The first thing is, I think, is people make the mistake of confusing looking for advice and looking for education and not understanding the difference because people conflate those two. They think knowing what to buy and knowing how to invest might be the same thing. And generally, I really at first had a feeling like I wanted someone to show me what to buy. I wanted the education to be someone who says, Andy, go buy this stock at this time. And it was sort of laziness that I didn't understand, right? Because I thought it wasn't that I didn't want to learn anything. I just was confused about it. So when someone makes a mistake, you can put it in usually 2 categories every single time. 1 or 2 or both of these things can happen. Number 1 is I was investing something that I didn't understand. That's number 1. When you look back at a mistake after being educated, say, man, if I would have known this and would have known this and would have known this, I wouldn't have made that mistake. And we'll dive into specifics. I don't mind in telling people about money I've lost because everyone does it. I've seen people blow up their account. I've never blown up my account. I have seen people blow up their account. But what it really is in hindsight, after you learn something like, man, there was no reason for me to lose that money at all once you learn a little bit. So the first category is lack of knowledge. That is number 1 most of the time. Now, there's a second category where you make a mistake where you knew better. And that's just like anything in life. You knew better than to do that. And that's where that natural man, I think there's some quote, this is the natural man is an enemy to God, right? There's this natural part of us that says, hey, I want to do this even though I know I shouldn't. So it's more about temperament in those cases, where either greed or more often panic makes you do something that you know you shouldn't do, that breaks the rules, but you're overcome by greed and you're overcome by panic. And so you buy what you shouldn't have bought with FOMO, or you sell what you shouldn't have sold with terror. And so Warren Buffett says it all the time, so does Munger, that knowledge is huge and temperament is huge, with what Warren Buffett often calls the vicissitudes of the market. The ups and downs can make someone do something that they know they shouldn't do. So if you talk about mistakes, you want to avoid those mistakes, become knowledgeable. Don't invest in things you don't understand. Become knowledgeable. Don't take the hot stock tip. Don't give your money to Wall Street to manage. Learn how to do it so you cover the knowledge thing, and then develop an investor temperament to where the vicissitudes don't bother you and you stick to it, which really is like everything in life, right? In sports, you got to know how to play, and then you got to not do stupid stuff. You can't get emotional about it. In a marriage, you look at a mistake like, unfaithfulness. That's not a knowledge problem, right? You're not supposed to be doing that stuff, everybody, right? And yet some people do it anyway. And so it's that type of thing. It's like your diet, that's the one I struggle with the most. I know that ice cream has 235% of the daily saturated fat that I need in my body. It's not a knowledge problem. It's just, I like ice cream. So that's why we look the way we do. But choose your battles, I guess. So when it comes to investing, knowledge solves a lot of problems. Avoid mistake. Temperament, doing what you're supposed to do, knowing it.
It's only been in my later years have I realized the importance of temperament and investing and what a critical skill set that is. Now,
huge. And we can get specific later. We can get specific on this later. We can actually show examples of where I didn't know what I was doing, or I did something that I knew I shouldn't have done and did it anyway. So I can share those stories, those war stories.
I want to hear these war stories for sure. Now, the thought process I was going with, you talk about knowing the business. We've talked about this a lot. What does it produce, right? How important that concept is. However, why is buying a stock without understanding the business so dangerous? Because I think it happens all the time.
Yeah, Warren Buffett has two terms that he'll often use in terms of defense and defending yourself against risk. The first one is moat, and the second one is called a margin of safety. And those are great concepts to learn about risk management. So a moat, what's a moat? Well, a moat is not a bulletproof defense. People can cross a moat. The question is how deep is the moat? How wide is the moat? How many sharks and alligators are in the moat? Is it made of lava? Whatever. How hard it would be to take the castle. So I'll give you an example that I often use on this of that's a really easy thing to understand conceptually. Okay, you got a castle, you got a moat, great. But to translate that into what it actually looks like in a stock, right? What does a moat really look like in a stock? So I'll give you an example of a great one. And he brought this up in his letter to the shareholders, maybe 2 or 3 years ago, so fairly recent. So back in the year 2008, I would say, so almost 20 years ago, he started selling puts at about a $75 strike on Burlington Northern Santa Fe Railroad. And so the stock's trading at like 80, 81. And he says, look, I'll promise to buy this if it falls to 75. And he got a fat premium. It's like $6. It was just this fat premium because the stock had fallen a bit and they were worried it would fall further. And he winds up buying a bunch, gets a bunch of premiums. and he uses that money to buy the stock. And then finally, he decides he wants to buy the whole railroad, and he buys at about $102 a share on average. And he buys the whole dang thing. And so now it's no longer the only way to own it is to buy Berkshire, because it's a subsidiary now of Berkshire. Berkshire owns the whole thing. It's not traded on the exchanges. So Buffett comes out, after doing this almost 20 years, he says, let's see where we're at on this one. He always starts off with a mistake, but then he'll say, here's something we did right. 40% of the nation's freight in North America, 40% of the nation's freight is rail. So just think about that for a minute. 40% of the stuff that is shipped touches rail. And Burlington Northern Santa Fe is the largest of that group that can service that 40% of stuff. So if you want to be a real estate investor and you say, stocks are just paper and they're worthless, that's fine, but maybe I decide not to ship your lumber to build your house anymore if you're not nice to me. What about the grain that makes the cereal for your kids to eat in the morning? What about the soybeans? What about the feed? What about the steel? You're going to put steel on a 747 and fly it across the country? You're going to put steel beams in a semi that can't hold that? So rail is lifeblood. You don't eat. Food, clothing, shelter. No rail, no food, no clothing, no shelter. So all of a sudden you have something that you might say is indispensable to our nation running right. It's almost like a utility at that point, right? It's almost like the electric company or the plumbing company or the water company, right? So that's a moat. Now, to take that castle, I say, all right, I'm going to take them down. I'm going to start my own railroad and compete against them, and I'm going to get my share of that market. I'm going to take them down. I'm going to replace them. I'm going to take down WordPerfect by Word. I'm going to take down Quattro Pro with an Excel spreadsheet, right? I'm going to take them down. Well, it would take about a half a $1 trillion to do that, about $500 billion to do that, and it would probably take 30 years to build the infrastructure. So if a guy has that idea, he's going to go to a bank and say, or investors say, yeah, let's raise a $500 billion and let's wait 30 years before we can even get it built yet. And that's just not a viable idea for most investors. Well, I'd rather go invest in AI, or something else. So to raise the capital to create a business that could take down Burlington Northern and to build the infrastructure and the time it would take, I guess it could be done. That's a moat that could be crossed, but you see how wide that is? So that's really what the concept of moat is, to say, how would you stop Coca-Cola from selling Coke? If you go to McDonald's and you see the drive-through, people are in there and they're going to order Cokes, Big Mac and Coke. How are you going to stop that from happening? How are you going to stop them from doing that in a mass scale? They sell billions of burgers every day, and every one of them is washed down with an ice cold Coke. How do you stop that? And so a moat, to answer your question, is if you understand the business from a resiliency standpoint, you have that knowledge, your risk just went down. But if you now contrast what we've just talked about by getting a tip from your neighbor.
So far, it's been great. I needed a source where I could really enrich my education through stocks. I didn't really have an avenue for it, and it's helped me a lot. The simplicity has really gotten me on the track to where I enjoy the learning as well as it's really solidifying in my mind. And like, they're not just trying to sell you something, they really care about the people that are in the course, and they really do care about you and your personal goals, and what you want to do is to help you and your family and whatever your goals are in life through that. So it's really been great.
Right? Your cousin-in-law says, hey, I got a hot stock and this price is going up. Let's buy it because the price is going up. And they're worried about the stock price rather than the moat. The other thing that Warren Buffett talks about, and I'll give a real estate example, is a margin of safety. So, for example, I like to use debt as a way to short the dollar in real estate. So let's just take, a single family home, for example. So Marcy and Andy would go out and we get a basic single family home, 4-bedroom, 2-bath house, something like that. How much debt do we carry versus how much equity do you have? And how far can those rents fall and still cover the payment? Well, if I run it really hot and I borrow as much as I possibly can to where the rent almost equals the payment, and I pull that out tax-free, so I have this money tax-free, but now I have a real estate property that's running really hot to where a little dip in the rent would put me in a negative cash flow, and if you did that across a bunch of properties, you'd be in trouble. So you got to have a good debt to equity ratio there. The equity you have in the home and the debt needs to be small enough where there's some flexibility in that, the rent could fall quite a bit and you'd still cover your payment. You'd be safe. So that margin might be discovered a margin of safety. In other words, am I buying this at a price that gives me a margin of safety that I really have a lot of room for things to happen? And so those are the types of knowledge, just 2 examples, where you say, what does it look like to know about a business before you buy it, as opposed to just taking a tip from your cousin-in-law. Those are hints, and it's a much deeper discussion with fundamental analysis than that, but at least it gives a conceptual example of what it means to kind of know what you're buying. If you're going to buy real estate, you got to know a little bit about real estate. If you're going to buy gold or Bitcoin or oil, you got to know a little bit about it, or you're gambling.
Indeed. I love that, just that deep understanding. I remember going to Berkshire Hathaway and seeing, they to the shareholder conference and just seeing all the businesses they had and seeing trains and
they love it.
It just boggled. It was amazing. And I was like, okay, they know their stuff. Yeah. Anyone else? Why would you buy trains, right? But they've got it figured out. All right, one last question before we hit the break. Funny enough, a couple weeks ago I was in the ocean. I was thinking of you and quoting Warren Buffett, and I think it was Warren Buffett, or maybe it was Charlie Munger, but I think it was Buffett.
The tide goes out and you see us swimming naked.
Yeah, that's exactly it. That's what I was thinking. The question that I had that goes along with that is, what's the biggest mistake investors make during market corrections?
Selling instead of buying. That's probably the shortest answer I've ever given in the history of this podcast.
You could probably end it right there, but do tell.
Well, let's go to a different Buffett quote. Probably his most famous ever. Probably the most famous thing he's ever said is, he said, quote, "I will tell you how to become rich. Close the doors. Make sure no one's listening. Close the doors. Be fearful when people are greedy, and be greedy when people are fearful." So a market correction is fear. You should be buying as much as you can buy, and instead you're one of the sellers. And that is so easy to understand because as a consumer rather than an investor, maybe your favorite day of the year as a consumer is Black Friday because prices go down. So a Black Swan event caused prices to go down. So you got Black Friday for the consumers, you got Black Swan for the investors. And in 2021, talk about Buffett, in 2021, his 2021 Berkshire letter is one of the best he'd written in all of them he's written. And he said something to the effect of this. I won't be able to quote this perfect, so forgive me, I'll paraphrase. But in that letter, he says, we have a lot of businesses. We have some that have great economics. We have some that have marginal economics. Some are poor. But we have all these businesses. But he says when it comes to the common stock, right, the stuff you can just buy on Wall Street as opposed to trying to get something privately, he said there's just certain times where these prices where you can just buy pieces, meaning shares, he calls it pieces, where the prices become so low systemically, the whole system's so cheap that you can buy. You just find wonderful businesses at wonderful prices, where he says you can buy pieces of wonderful businesses at wonderful prices. And he said that shooting the fish in a barrel experience, that's what he calls it. That shooting a fish in a barrel experience doesn't happen outside of the common stocks because, and it certainly doesn't happen in masse, he says, in mass. Because if I went to buy, let's say I go to him, he owns this furniture store called R.C. Willey, and I said, Buffett, I want to buy R.C. Willey. Now it's the owner and the buyer, and we're negotiating, and we're looking at the profit margins and the multiples, and we're saying, what's this thing, what multiple is this worth, right? It makes X a year. What multiple of that am I willing to pay for those earnings? But in the market where there's panic, that's the beautiful thing about stocks, man, is when there's a panic and people are selling because of the price tag going down, which is now detached from the underlying business. They're just selling because they see the prices going down and they see that as their wealth evaporating, not understanding that the real estate of the stocks are still there. They're fine. It's just people are panicking on the price. And that detachment of price from fundamentals creates the opportunity to, what he said, shoot the fish in a barrel and buy wonderful pieces of wonderful businesses at wonderful prices. You don't get that in negotiation. You certainly don't get it in mass in one-on-one negotiation. So the worst mistake you make in a correction is be on the sell side and be part of the panic instead of being the guy that's greedy when other people are fearful. And each crash I've had, this is really important. The first crash I was aware of, I think it was 1987, so I was a year out of high school. I didn't participate. I didn't know what the heck I was doing. What do I know? I'm 18 years old, in 87. But then the next one was in 2000, about 13 years later. And the year 2000, I didn't participate in as much because I didn't understand it very much. I was, kind of learning about things and getting going. 2008, we participated in, right? And COVID, we backed up the truck. So as you get experienced, COVID was just awful. I had one of my friends lose both his parents within a month of each other. They both died of COVID, so it was tragic from a human standpoint. From a fiscal standpoint, it's if you back up the truck when those prices are that low, look at every single stock chart ever and look at a crash. Every single stock chart ever, look at the crash and say, when do you wish you'd have been buying at the worst point in the chart? So as I don't know how to pick a bottom. But I do know this, as the value drops and the value drops and the value drops and the value drops and the value drops, the price drop, there's a certain point there on the way down where it's like, this is a freaking bargain. If it goes down further than that, who cares? Because this will work. Fundamentally, this is value. This will work. And you just start buying at that point. And you can't pick the bottom usually, but as it falls, price, value, price, all of a sudden the value is bigger than the price. At that point, you start buying. If the price dips down, it'll be back higher. So that's a huge mistake. That's the long-winded version. When you said, what's the biggest mistake in a correction? I say, well, selling, not buying. That's the short version. That stuff I just vomited out is the long version.
Beautiful, love that. Andy, you've mentioned mistakes, personal mistakes. You alluded to what's one that comes to mind when you're like, man, that was a good lesson I learned.
It's funny. Our education is so inexpensive comparatively to mistakes. It's unbelievable. I mean, people can usually get involved with us with under a couple $100, and they get started in a big way in a couple $100. We have classes that people can take that are robust for $99 on richdad.com. You go to richdad.com and hunt around, you'll find a $99 course that's just robust. So, you're talking hundreds of dollars, not millions of dollars, right? And certainly not tens of thousands of dollars. So what's funny is way back I was doing some option trading very successfully. And I was very aggressive trading some credit spreads on Apple. And I was actually trading it. There's 5 directions of a stock. You can stay the same. That's one direction. It can go up. That's the second direction. It can go down. That's the third direction. But it can go up a lot, and that's a fourth direction. It can go down a lot, which is a fifth direction. So I was kind of going with 4 out of 5 directions. And I was making so much money in the early days of Apple that there was this cruise that I was going to go on. Now, this is so far back where now you can have internet on the cruise. You can check your stocks on the cruise. But back in those days, once you got out of port and got out to sea, you were just, there's no phone, no nothing in those days. So I've got this really nice position on Apple, and I just closed out for big profit. It was time to do another round for cash flow next month, and I knew the position sizing rules. I knew everything that I needed to know to keep making the money I was making, and I knew I had this cruise coming up. I'm like, man, I'm not going to have internet access on this cruise. And I was just making so much money that I thought, I'm going to go bigger. So I knew the position size rule. I broke the position size rule. That was rule number 1. Then number 2, you got to tend the sheep. You got to know where you got to know where your kids are. You got to tend them. So I go on this cruise, man, with this huge position. I'm like, it's going to be fine, man. I'm not going to worry about it. I'll come back and the money I've made so much money. And I just remember getting back into port where I had communication, and I saw the price of Apple just freaking soared. It soared so high. It surged like unprecedented, historic. And, it wasn't a huge loss. I want to say it was like 30 grand, so it wasn't a huge loss. But that was a nice little seminar I put on for myself, wasn't it? It was only like 30 grand, so it wasn't like devastating or anything like that. But, it was enough to say, geez, dude, would you want, no one wants to take 30 grand, just light it on fire, especially back in those days when I was younger. But that's an example of temperament instead of knowledge, right? I knew how to do it. I just got greedy and took a chance. And I thought, the smart thing for me to do would either been setting alerts to automatically sell it, but then you get whipsawed out. Well, fine, you get whipsawed out. Or just say, go on vacation for a while, Andy. Don't worry about it. You got dividends coming, you got other stuff coming. What do you gotta take that risk for, you stupid? So I've never done that again. Never done it again. I learned my lesson, and I've never done a position size. Now my account is far, far larger than it was in those days, but still not going to break the rule. Still not going to break the rule. So that's an example of me being stupid. Happens.
It happens to the best of us. But the key is the wisdom in that is it wasn't repeated again. That's the wisdom in that.
No, I have not done that again. Not because of the money loss, but because of the pride. It was a real shot to my ego. I'd started teaching at that point a little bit, and it was very early in my teaching career, and to have lost a stupid trade like that and then have to be asked to give a speech on it. That's why I like confessing my sins here in the confessional, so everybody knows that I've been perfect. So it's good to come and see the priest here and confess those sins and get them out in the open public. So at least I can be honest about it.
That's good. We appreciate the honesty. Your sins have been forgiven, sir.
Yeah, I don't know how many rosaries I got to do on that, but hopefully I've done enough.
There we go. All right, last question here. If my action question, if someone listening wants to dramatically reduce the number of investing mistakes they make, what's the first action they should take this week?
Well, we always set that up with stockcastbonus.com, of course. That's a great first step, but that's a first step towards something much larger. We talked about knowledge and temperament. And I will tell you, if you really want to go beyond just, introductory, dip your toe in the stuff, get free stuff at stockcastbonus.com, I'll tell you, we have this thing called the Mentor Club. And go to Stockcast Bonus first and get the free stuff first and dip your toe in and see if you like that first. But But if you think about Rich Dad Poor Dad, that book certainly is a book on accounting. It certainly is a book on context. It certainly is a book on the difference between an asset and liability. It certainly is all of those things. But as I've gotten older and as I've reread it and thought about my experience with the book, more than anything else, that book is a story of mentorship. Look at the cover. It is the story of someone who had someone in his life that taught him and guided him and gave him lessons. And I would say that mentorship is so important because there are certain sports that you can't read your way to success in. Reading can be a start, but let's suppose you wanted to learn how to swim in the ocean, and you read a book on swimming, and you finish the book on swimming, and you take a test and you get an A in the book on swimming, and then I throw you in the ocean and you drowned because you don't know how to swim. There are certain things that you learn by doing them, not reading about them. And I would say investing is in that category, that I've learned so much more from mentors as I've done it with their assistants. And if you want to avoid, you're going to make mistakes either way, but because no one's perfect. But if you really want to reduce mistakes, get a friend like mine, like Corey Halliday, who's managed more risk than anyone listening to this podcast likely has. You know, as a Series 4 option principal where you're the head risk manager at a Wall Street firm, that puts you in a pretty exclusive group of risk management. Having a bond and a friendship and a relationship and an email address with a guy like that, that's a mistake reducer, massively. People like Noah Davison, who are premier trade adjusters, having access to a guy like that and watching what he does every week in our mentor club, having mentors and teachers that know so much more about risk management than the average bear, that the protection with education and mentorship, that protection is remarkable and valuable, and it reduces mistakes drastically when you have someone where it's not their first rodeo. And that's the problem with damn school, is you go there, keep your eyes on your own paper, you know, do your own work, you know, don't use any help, don't do that, you know, all of you, where in the real world, man, I'm absolutely going to look on Noah's paper, call him up and say, let's talk about the answers because I'm in an exam right now and I need some help. That's the real world, not school. So I know I have a serious tone on that. That might have even approached a rant. I don't know if that qualified. But mentorship is what the book Rich Dad, Poor Dad is also about. Mentorship. And the first step to that is to do things that are free with no risk. Cash, you know, you go to stockcastbonus.com, take some webinars, read some ebooks, and you think, wow, this is pretty cool. I could maybe dig this. Then you take a next step. Say, you know, I'd like a mentor in my life. And it goes without saying, I don't need to sell anybody on that. You have someone that knows so much more about it than you. No, it's going to help reduce mistakes.
Indeed. Andy, thank you so much. That I couldn't agree more. And on a personal note, you've been a great mentor to me. So I appreciate the lessons.
And likewise, vice versa.
Everyone needs a mentor for sure. Listener, the stock market is a tremendous wealth building tool, but only if you avoid the mistakes that quietly destroy long-term returns. The goal isn't to be perfect. The goal is to become a little wiser with every investment that you make. And again, huge thank you to Andy Tanner for sharing decades of investing wisdom and helping us avoid some of the most common traps investors fall into. Now, if you're ready to build a smarter investing strategy and avoid the mistakes that cost people thousands of dollars, head over to stockcastbonus.com right now. You'll find free free tools and resources designed to help you to invest with confidence. And if you've enjoyed today's episode, like, subscribe, leave us a review, share it with someone who's just getting started in the stock market or someone who could benefit from avoiding these common mistakes. Thanks for listening to the Rich Dad Stockcast. I'm Denney. Stay smart, stay invested, and we'll see you next time.
This podcast is a presentation of Rich Dad Media Network.